Two of the most reputable investors in America are at odds with one another over their divergent predictions for the direction of the economy. Each has a stake in favor of Bitcoin bulls. Cathie Wood, CEO of Ark Invest, is positioned on one side. Her Ark Innovation ETF has strong positions in businesses including Tesla and Coinbase. On the opposite side is Michael Burry, a near-mythic doomsayer due to his 2007 wager against the housing market. According to a source, Burry is reportedly risking $31 million worth of put options through his Scion Asset Management fund, or 235,500 shares, on the success of Wood's Innovation ETF. The debate has primarily been cast as a between big-picture, ideas-driven investing and data-driven fundamental investing. Analysts who support Burry's wager noted the enormously inflated price-earnings ratio of Ark holdings. The issue is best shown by the size of Ark's stake in Tesla, a manufacturer whose market valuation is greater than the sum of the following 5 largest automakers combined, yet which only seldom makes a profit. As detailed in CoinDesk's in-depth report, Wood rose to the top ranks of investors thanks to her unwavering confidence in Tesla throughout the company's difficult period in 2018. Burry already held a sizable $534 million short position against Tesla before shorting Ark, placing him in line with Tesla Q critics who think Elon Musk's lofty claims about things like full self-driving are empty rhetoric. But this is only the debate's seductively philosophical surface. If you pay closer attention, the argument between Wood and Burry is over something that is both more minor and more significant: their divergent views on inflation. As benefits his reputation for prophesying doom, Burry is a well-known inflation hawk, who in February 2021 compared American monetary policy to Weimar Germany. Proponents of Bitcoin primarily hold that viewpoint. Burry thinks inflation will destroy the kinds of businesses that Ark owns, including Coinbase. Growth or innovation equities are at risk from inflation since even moderate persistent inflation would force the Federal Reserve to boost interest rates to control the money supply. Since so few of the companies in Ark's portfolio are profitable, it is predicted that they will require more cash through loans or other forms of financing when they expand. The cost of that capital increases as base interest rates rise. About venture capital and private equity hedge funds, it would have a comparable or even more negative impact. In contrast, Wood asserts that she now thinks the current inflation is only temporary, accurately pointing out that the cost of commodities and used cars is returning to normal. When headline inflation breaks and recession fears rise, she claimed in a tweet thread in response to the news of Burry's short position, the equities market is likely to favor disruptive innovation methods once again. This comes as a bit of a surprise from Wood, who had backed Donald Trump's re-election and could have been anticipated to join the majority of right-leaning inflation hawks. Her opposition may indicate a flexible mind ready to reevaluate the situation. On the other hand, it can be a question of convenience because low inflation forecasting enhances the credibility of her fund's theory. And Wood undoubtedly has a reason to promote her book. Thanks to holdings in businesses like Zoom that achieved astronomical gains during the pandemic, Ark returned a startling 150% in 2020 after a sustained period of exceptional annual returns of approximately 30%. Due to its financial growth and increased capitalization due to its performance, Ark now manages almost $22 billion, up from $9 billion in October of 2020. But Wood's impressive results have stopped, at least temporarily. The Dow Jones Big Cap Index has increased by 20%, whereas Ark has decreased by 6% this year. But beneath the surface of Wood's thesis, there is another approach to the inflation debate. As family saving rates rise and more people participate in the stock and crypto markets, a phenomenon known as asset price inflation, some claim that a loose money supply has been beneficial for speculative investments. However, it's hotly contested whether categorizing this as inflation is correct. The asset inflation theory has a crucial implication that money invested in Bitcoin or Tesla shares aren't placing demands on tangible products. Therefore, increasing asset prices may actually be lessening the possibility of higher interest rates and actual inflationary pressures. If so, funding for innovators may remain affordable even if money printing inflated speculative assets. Wood concluded a lengthy refutation of Burry by saying that she doesn't think Burry understands the fundamentals of generating tremendous growth and investment opportunities in the innovation arena. As long as Wood and her fellow travelers can entice enough of that money into their high-risk wagers, those fundamentals for Ark may actually entail ongoing substantial U.S. public spending. That concludes today's video. Thank you for joining us till the end, and we'll see you in the next one. Goodbye.